Day trading indicators are never wrong. How's that for a controversial statement? Okay, Barry, defend yourself. I will be happy to. All right, so why would I say that indicators are never wrong? Day trading, and this would apply to swing trading as well. And by the way, it also applies to whatever market you might be trading, whether it's stocks, forex, futures, commodities, even cryptos. Okay, so first of all, well, let's bring up an indicator. What's a common indicator? A common indicator would be, and let's do a simple one because I want to keep this super, just give you the concept, the idea here, and I'll show you a little bit about how to trade it as well. So we're going to do a simple one, do the MACD, very, very common. All right, and so there we've got it. By the way, the settings, I'm just going to use the standard settings right now. Fast 12, slow 26, smooth 9. You can pause the video there if you want to write that down. I'll just use everything default colors, all that stuff. Okay, so there it is. Oh, actually, you know what? That's those colors are not that easy to see. Let me brighten up those colors a little bit for you. Okay, so there we go. All right, so first of all, let me just defend the statement that indicators are never wrong. So here is one of the controversial things. It's not really controversial. It's just that a lot of people don't know it. And as a professional trader, you've got to really understand what you're trading. I find that a lot of people learn trading by just, or try to learn trading by just pulling up a chart and going through indicators, plotting them on a chart one after another, to see which one, quote unquote, works. That is not the way to learn how to trade. You've got to understand what the indicator is. So first of all, these lines down here are technically not the indicator. What? But Barry, I saw you just put the indicator on there. Yeah, but that's not literally what it is. And if you want to make literal money, you better understand what you're literally measuring on your chart, including indicators. So these lines are actually the visible representation of the indicator. So what is the indicator? The indicator is a math function. All indicators, that's what they are. They're math functions. So when I say indicators are never wrong, well, that's because math is never wrong. If I type 2 plus 2 in my calculator, you do the same in your calculator, we're both going to get 4 roughly, I'd say about, 100% of the time. So that's why indicators are never wrong. They're math functions. And actually, if you want to be real literal, they're functions. And therefore, they are never wrong. Okay, and so what is the MACD math function? Well, let me show you here real quick. Okay, so that's it. And MACD stands for moving average convergence divergence. And the formula is the 12-period exponential moving average minus the 26-period moving average. And of course, you can change those numbers. The numbers of the look-back period are the number of bars over which it is measuring the average price. Okay, so that's it. That's the actual indicator. And you can do this. In fact, I encourage you to do it with any indicator that you're looking at, whether it's no. See, I choose this one specifically because it's so darn simple. But you could do it with stochastic, CCI, RSI, and most of them are more complex than this. This one of the most simple, and that's actually why I'm using it today. So coming back to our chart, you'll see the numbers there, 12 and 26. Okay, so what is this measuring? So what this measuring is, look at this, we're going to get very literal here, because why? Because we want to make literal money. All right, so, and it's important to, all jokes aside, it's really important for you to understand what you're trading, right? What you're trading, what it means, so that you're not just throwing lines, indicators on a chart and saying, oh, okay, let's see if this one works. So we're going to make what we're going to do here, you got your 12 and your 26, right? So we're going to pull up the exponential moving averages that we just talked about are in the formula. So 12-period EMA, we'll make that one green. And then we'll bring up our, we'll do the 26. EMA, apply that to the chart. We'll make this one red for just for simplicity here, make it line 2. Okay, and there you go. So now you can see quite literally what this puppy is doing. Remember, moving average, it's called MACD for a reason. And what it stands for is, there we go, MACD. Moving average, and the moving averages we're measuring are what? There we go, 12 and the 26 exponential moving averages. And then the convergence and the divergence of the two. So, very important to understand, that's what this is. These are not just random lines that might magically work. They're not based on ancient Phoenician numerology or some magical Mayan, moon movement. Oh, I'm just being crazy here. But it's important to understand because look what's happening here. What this is measuring is literally these two moving averages. So you got your 12-period moving average. You've got your 26 moving average. Now, when the 12 moving average moves away, diverges, gets further away. So look at the space between these two moving averages. They're getting further and further and further away. That's when you will see this plot on the chart. When they converge, in other words, they get closer together, then you will see these two lines move together. Notice it's not exactly the same, right? This is not just the two moving averages plotted here. So, for example, here they cross. Okay, what that is, but these don't cross. Why? Because these are not really the two moving averages. These are actually, it's the MACD line that is measuring, which is the green line here. That one is the one that's measuring, okay, are these actually moving, are these two moving averages moving away from each other or toward each other? Away from each other diverging or toward each other converging? So it's the space between the two moving averages, and it's just the green line here. And when it's going down, that has nothing to do with price should go down. And that's where people get messed up when they don't understand what these indicators literally mean. Because they might think, oh, well, when the green line crosses below the red line, this is how amateur traders would talk, well, then we should go short. No, we should not go short. All it means is that, the 12 moving average is moving back toward, it's closing the gap between the 12 and the 26 moving average a little bit. That's it. That's all it means. Has nothing to do with whether price should go down or whether you should go short. So you got to demystify this stuff, okay? And then when they start, and then we can look at all kinds of stuff here. So now when we've got the 12 moving average, the green one, moving below the red one, okay, again, it's moving away. So here it's moving away. And so then you get the green line going down, the MACD line. And then when the MACD line comes up, it just means, oh, the 12 exponential moving average is closing the gap between its and it's getting, I want to really say close the gap, but it's getting closer to the 26. That's it. Does not mean you should buy. And it certainly doesn't mean you should buy or sell when it crosses the zero line. All right, so it's now. So what is it measuring? It is measuring the acceleration of price action. But one more step. It's measuring the acceleration of price action, and these numbers become very important. Over the last 12 bars relative to the last 26 bars with a weighting on the more recent price action, because that's what an exponential moving average is, essentially. Again, just to keep things simple. Okay, so that is all the green line. Now, our red line, that can be called different things, signal line, etc. That's where your 9 moving average comes in. Okay, but the green line is just the difference between the 12 and the 26, my green line, the MACD line. Now down here we have the difference in, maybe we'll do another video on that. We don't have time to go on that. That really, all that means, in fact, I can just tell you real quick. So we've got our zero line here and the MACD histogram, sometimes it's called, that's a horrible name for this. That's just the style of plotting. But what it really is telling you how far these two lines are away from each other. So the green line tells you how far the two moving averages are away from, well, not how far they are, but whether they're moving apart or together. and then the difference here, we'll call it diff, and that's a good term for it because it is showing you the difference between these two lines. Okay, and again, the red line or the signal line, that is just a 9 exponential period moving average of what's going on here. Okay, so it kind of smooths it out even more. So how would we read this? Okay, real quick. So how we read it is we just say, oh, okay, there's acceleration to the upside, but that is not necessarily that we should buy. For example, here we have deceleration. All right, but again, that doesn't mean you should short. That just means, okay, the market's been moving up, accelerating in its price action. Whoops, get some deceleration, and then it goes the opposite way, but price doesn't go down. That's not a bearish signal. So you could use this to say, oh, okay, I want to get in on aggressive price action, and then I want to get out when things are not as aggressive. Doesn't mean the move up is going to end. It just means that, oh, that dramatic energy that I entered on is now subsiding. Oh, so maybe I don't want to, stay in during that. Now, it does keep going up. And this is why it's important to understand the difference between trend, which is direction, and acceleration, which is MACD. So trend goes up and up and up, but it can keep going up without the same acceleration of price action. All right, and so that's basically it. All right, now there's a lot more obviously to trading than this, but this is, I just really wanted to, it's not even a lesson about MACD so much, it's a lesson about all indicators. Please, in the name of all that is holy in the world of trading, and there's really not much that's holy in the world of trading, but please understand what you're trading. Right? If you want to be a professional trader, meaning you want to actually trade and make money, that's what professional trader is. You do it for money instead of for fun. Hopefully for both. But you've got to understand what it is you're trading precisely. Because believe me, every professional trader, we know what we're doing. We're not just throwing lines on a chart and saying, oh, when the lines are up, we buy. Okay, that's so, wow. It's actually insulting to professional traders that amateurs would think that that could be done. So whatever indicators you're going to trade, if any, understand what it means, what it's mathematically, remember these are math functions, what's mathematically measuring, and then use that to inform you on what you're going to do. And by the way, let me just say one last thing here about this. No one indicator directly makes you money. Indicators do what they promise. They indicate. Right? They indicate something. So that can be very helpful. In this case, it tells you whether there's acceleration or not. I would rather buy while there is bullish acceleration. I would rather not buy when there's not bullish acceleration. And as you can see, price doesn't, like for example here, there's not acceleration in the market to the upside. Trend is still up, but not very much. So the reward here is not good. So yeah, this can be very helpful. I'd rather buy during these times. Bigger, faster moves, and that's what we all want to get in trading. All right, so get this, whatever indicator you decide to use, or even with when it's candlestick patterns, all that, understand what they mean. One of my favorite indicators, actually it is my favorite indicator, is what I call my cycle indicator. Highly recommend that you get it. I give it away for free to the trading community, and I show you how to use it. It's actually a modification of a common indicator, but I teach you how to do that in a recording that I have. I used to do it live, but now been doing it for so long that I decided I'm just going to put it on recording and give it to everybody for free. So used to charge for it, but now you can get it for free. So go to indicatorwebinar.com, check it out. Like I say, it's a recorded webinar. It's about 45 minutes long. And there I show you how to set it up on your charts and how to trade it. And I use it on every single trade I take. It is my core indicator. And like every other indicator, it's never wrong, but the reason I do it on a webinar is so that you learn how to trade it. Right, because there are details there. Okay, my friends. Well, oh, by the way, subscribe to the channel. I've got a lot more good stuff coming out soon. And if you subscribe, then you will get notified by YouTube when I come out with a new video. And that way you won't miss a single one.